Well guys, the stock market had another green day here today. Dow up another 275 points, S&P 500 up another 0.65%, NASDAQ up almost 1% here today. But we're not here to talk about what the stock market did today. We're going to talk about what the stock market has done over the past several years and the past several months. I'm going to give you my opinion on if the stock market is going up too fast with these stocks consistently rising. I'm going to show you a lot of metrics. I'm going to show you a lot of graphs here today. I'm going to give you a lot of information, and I'm going to give a big warning to a lot of individuals out there that are about to get themselves in a lot of trouble, and that's going to come in this video as well. So I hope you guys really enjoy this. We're going to go in depth on this, going to give you my opinions on this, and show you the facts and the data around this as well as my opinion. So I hope you guys enjoy this. Smash the thumbs up button. Leave me a comment down there if you have anything to add to this video. I'd love to hear from you guys as always, okay? We're looking at the Dow Industrial Average here for basically the past roughly 20 years, and I just want to point out a few things here for you guys, okay? You kind of had a lost time in the Dow from about 2000 to about 2006. The Dow didn't really move much. It went up a little bit, it went down a little bit, but the Dow actually didn't do very much for years. Their main reason was it was still coming off of that whole, tech bubble we had, and it wasn't just tech companies that were negatively affected. It was a ton of regular companies. Their valuations had gotten way too big, even in the Dow. So you had this like years and years where the Dow basically didn't move. It was pretty crazy, okay? But here you see, since 2009, the stock market has pretty much been up almost in a straight line. I mean, obviously, you had some big dips, in different years or different months, and some people, got thrown out of the stock market at some of those times. They got scared or whatever. And so you definitely seen some of those type of corrections and pullbacks in the stock market. But overall, when you just open it up and you look at the past, 10, 11 years, you see that it's almost up in a straight line. We're talking about the Dow at the lows, under 7,000. I think the Dow actually bottomed out at right around like 6,700, but let's just call it 7K, okay? And here we are with the Dow about to hit 30K. That's an 11-year span. That's over a 4X, okay? Over a 4X in literally 11 years. And you could expect your money to, at least double every 11 years. And if you just, have it something that mirrors the Dow, for instance, something like a double, maybe a 2X in 11 years, but that's usually stretching it. But a 4X, I mean, and actually over a 4X in a matter of 11 years. That's crazy. That's some of the most insane performance we've seen in the Dow in the past number of decades. Now, some people say maybe the Dow should never have gone down to 7K during the Great Recession, and then, there was too much fear out there. It's definitely an argument that could be made for that. And some people say, well, we shouldn't be at 30K right now. We're too high as far as the market goes, okay? And if you see the NASDAQ, you're going to see some even more dramatic things, okay? So basically, there was the lost decade and some, I like to call it, in the NASDAQ. I mean, the NASDAQ, you go back to 2000, NASDAQ's over 4,000. It took all the way till like 2014 for the NASDAQ to finally hit 4,000 again. So basically there was like a 14-year time frame where the NASDAQ was lost, okay? Where it was like, is it ever going to reach new highs again? It was absolutely incredible, but that's what happens when there's an absolute huge tech bubble and stock market bubble, obviously like there was in 99 into 2000. It takes a long time to recover from that. But as we see here, since 2013, the market has been up and away. I mean, you look at the NASDAQ, 2013, NASDAQ's at 3,000. And here today, we're at, almost 10,000. We're approaching 10,000 now. So basically, we've gotten over a 3X in the NASDAQ in a 7-year span. Usually, you can expect a 1X in the NASDAQ every 7 years, okay? A 1X. We've gotten a 3X, a 3X in a 7-year time frame. That's absolutely over a 3X, actually. That's absolutely unbelievable. Now, why is this? Why is the stock market, whether we're looking at the Dow, S&P 500, the NASDAQ, why have they gone up so much in recent years? Well, there's a few reasons, okay? Obviously, you've had taxes cut back on corporations. You have taxes cut back on individuals, which mean individuals have more money to invest, maybe in the public markets. You obviously have the deficit going crazy. Government's still spending money left and right. The deficit has been out of whack for years and years now, and it's actually getting worse right now. The deficit's even getting worse, okay? You've had quantitative easing. You have some government programs programs in that basically where the government steps in, the Fed steps in and actually buys assets, okay? Quantitative easing is definitely a reason for this. Stock buybacks could also be a reason for this, where companies actually are buying back their own shares. Sometimes that makes their stock price go up. That also takes shares off of the market, which makes companies' EPS look even stronger, which makes more and more investors obviously want to buy in when those shares get bought back. And I mean, obviously, we're not going to get into this into detail, but some people feel like stock buybacks are a good thing. Some people feel like stock buybacks are a very bad thing for the economy overall, that money should be used on other things than a company's buying its own shares back. That's a whole separate argument, but there's no doubt stock buybacks have helped the stock market dramatically over the past decade get to where the stock market is. Then on top of that, you add on companies' profitability and companies to grow. It's never been like it is today. We're talking about these type of companies, the Amazons, the Apples, the Googles. These type of companies are able to grow at such a rapid rate compared to anything we've ever seen in history, okay? Apple in their latest quarter, okay, we're talking on a 3-month span, had net income. We're not talking revenue. We're talking net income on their bottom line of over $22 billion. Companies in the past couldn't have even dreamed of having $22 billion in revenue, never mind $22 billion in net income in a 3-month span. We've never seen profitability like this before from companies, okay? Look at Google McDougal in their latest quarter. Google McDougal just had over $10 billion of net income in a 3-month span. These are the type of numbers that companies in the past, they couldn't even dream of these type of numbers. It's absolutely on a whole different level. Microsoft, in the latest 12 months, Microsoft has made $44 billion of net income. $44 billion in literally the past 12 months Microsoft has made on their bottom line. Not talking top line, we're talking bottom line. Companies in the past could never have even dreamed of these sorts of numbers. It gets absolutely incredible. A company like Amazon, which is still growing very rapidly, in the trailing 12 months has just pulled in $280 billion, yes, with a B, $280 billion of revenue, okay? So you have these type of tech companies that are growing much faster than anyone ever thought possible and much bigger than anybody ever thought companies could be. I mean, we haven't seen companies grow like this really since like the Rockefeller days. You have to go back to those time frames to really see companies growing at these type of rates and getting this big when you compare it to the rest of the economy out there. It's absolutely crazy. Then you add on the fact that interest rates, if you're talking about a savings account, are like 1%. Keep in mind, we're talking about why has the stock market gone up so much in recent years, okay? Like savings accounts are at an average of what, about 1%? So you think, if somebody has money laying around, they're going to want to put it in a savings account. You're not even going to be able to keep up with inflation. You really need at least like 2% on a savings account roughly to keep up with inflation. You get your 1%, and a lot of the big banks actually offer less than 1% on a savings account. People are going to look at that and they're like, really? Do I even want a piece of that? Then you add on the fact that real estate prices, if you look at something like the Case-Shiller U.S. National Home Price Index, you're going to look at, we've had kind of the last decade plus when it comes to housing prices. So a lot of investors haven't really wanted to, put their money into real estate because they've kind of seen that, real estate hasn't done that much recently. And especially if you back it up to 2005. So a lot of folks are kind of like, do I really want to put my money there? And so what you have happen when you add on all these factors, when you add on all these different things we just talked about, and I could keep adding on, those are just some of the biggest factors, in my opinion, we see out there. You're going to get a stock market to go up and go up and go up, okay? And listen to this, guys. For the first time ever, index funds have more money in them than active funds, okay? Index funds, passive investing funds, where essentially your money just kind of mirrors the S&P 500 right now. There are more people putting money into those than ever before, okay? And this is actually a huge issue in my personal opinion, okay? This is making folks like you and me that are actually the stock pickers that actually pick individual stocks. We're becoming like dinosaurs, I guess. Like more and more people are like, let me just, put it in something that mirrors the S&P 500. I don't have to put any any worry for it. I don't have to worry about, is my money best put in Tesla stock or Apple stock or Google stock. I don't have to worry about that. I don't have to read any, annual reports or conference calls. And so people are just looking at this and like, let me just, put money into an index fund and, I can expect my 7 to 8% per year. And that's all fine and dandy, but we'll talk about an issue here with this in just a moment, okay? Why do I put in the work? Why do I put in the work, to, become a successful stock picker? Well, because we just got 74% in the last year in the public account, okay? You're not going to get those type of gains by putting your money in an index fund. You can usually grow your money over the long term, but you're not going to get those type of gains by basically just sticking your money in an index fund. That's why I do it, because I'm always striving to, way outperform the markets. That's why I put in this work at the end of the day. That's why I'm willing to stay up late and listen to conference calls and read annual reports and all these sorts of things and constantly be looking into companies. This is why I do it, because those type of gains are life-changing type gains, even if you're talking about a 5-year span. Never mind, imagine if you outperform the markets for a decade, 2 decades, 3 decades in the future. But the fact is, a lot of us stock pickers, we're becoming like dinosaurs, where a lot of people are like, do I want to stock pick, or do I want to have somebody actively manage my money? Nah, let me just put it into a passive, fund that essentially is just, invested all around companies. Doesn't matter if it's a good company, a bad company, an undervalued company, an overvalued company. I don't care. It's just put it out there. That's what investors are doing right now, okay? Now, getting back to this whole, thing about, is the stock market going up too fast? I think a lot of it comes down to the performance recently in the stock market, and I can see why a lot of people would wonder, maybe the stock market's going up way too fast, okay? Look at this. 2017, market's up over 28%. This is looking at the NASDAQ. Over a 28% gain in 2017. That's absolutely ridiculous, absolutely incredible year. Then you go ahead, 2018, we step back, about almost a 4% downward move. Not a huge step back, but a step back. 2019, a ridiculously great year in the NASDAQ. A 35% plus gain in the NASDAQ in 2019. And here we are in 2020. We're what? We're a little over a month into the year, not even a month and a half into the 12-month span, and the NASDAQ's already up 7.3%. And so just looking at that, I can definitely understand why some folks out there would say, my gosh, when you just look at the NASDAQ performance over the past several years, it is ridiculous. 2019 was an insanely ridiculous year for the NASDAQ. And then you add on top the fact that the year, we're already up over 7%. Like, these are some huge numbers, okay? Now, something I always like to look at is PE ratios. I think PE ratios are the best metric, in my opinion, of kind of valuing a stock or valuing the stock market in general. And the fact is, PE ratios right now are over 25. We're at over a 25 PE ratio right now, which, let's just be quite frank, is high, okay? A 15 to 16 range is like fair valuation. Anytime you get under 15 to 16, you're kind of looking at an undervalued stock market in general. Anytime you get, over 20, you're kind of looking at a rich valuation. When you're talking over 25, you're getting pretty rich on that valuation. If you ever get over 30, watch out below, because then you're in straight up bubble territory when you talk about, a PE ratio getting over 30 at that point in time. And here we are at 25. We're way higher than the market should be in normal times. And so in order for this to make sense, in order for these numbers to make sense, we need some things to happen, okay? We need some things to happen dramatically to make these type of metrics like the PE ratio make sense in the end. We're going to need the United States GDP growth to step up in a huge way, because we're not going to get any more massive corporate tax cuts or something like that. We're going to need the United States GDP growth to really grow 4% plus, get to a 4%, 5%, maybe even 6% type number. So that way, companies can really start roaring in the profits and the revenues and all those sorts of things. And businesses can continue to grow and grow and grow. So they end up, those valuation metrics start to end up making sense down the road. We need that. We need China's GDP to get back on the right track. China has been going down for several years now. China kind of held it down for, a lot of these US-based companies for a while that were international companies. But lately, the China GDP has been down. We've seen countless companies over the past few years miss numbers, and a lot of them have missed because of China. We need China's GDP to get to a place where it's growing once again. Maybe they get back up to a 7%, 8%, maybe even more than 8% type number. You need that to happen as well, so these companies can, have some great profits starting to come out of China, whereas lately it's been, stagnant for a lot of these companies, a lot of these US-based companies. But not only do we need US and China GDP growth to step up, we need the European GDP growth to step up. Europe has just been bad. I mean, Europe has just been bad for years now. I mean, how weak the European GDP growth is, it's staggering. And a lot of companies, just their businesses are not doing that great unless they have some type of special, really special service or product in Europe that, everybody just has to get. Unless it's one of those special situations, there's just, like, companies aren't doing that amazing in Europe. So we need European GDP growth to get to a place where it's at least 1 to 2% again, okay? So I told you guys I have a little warning out there, okay? I have a little warning for folks out there, and it has to do with this, okay? It has never been more important than now to be a stock picker. Throwing money into index funds will get you into trouble. Just wait on it. If you asked me in the past, you said, Jeremy, I have some money. I want to invest this money, okay? In the past, I would have said, okay, well, let me ask you, a couple questions here. Do you want to work to make your money into money? And if you said yes, then I said, okay, you could become an individual stock picker, you could become a real estate investor, or you could start a business. Those are your three options if you want to put in work. And if you said, nah, I don't want to put in the work, then I would say, okay, perfect. Stick your money in something that mirrors the S&P 500, some type of index fund, and guess what? You're going to grow your money over time. But as of right now, I could not look somebody in their eye and tell them to invest their money into an S&P 500 index fund right now. I just couldn't say it when we're at the type of PE ratios we're at right now. When we've had the type of move in the stock market over the past, months and years, I cannot confidently tell them, put your money in an index fund. I can't say that right now. I flat out can't say that. We're not at the time where you should be buying index funds, in my personal opinion. The stock market is way too richly valued, in my personal opinion, right now to be buying into an index fund. There are some stocks that are a good value out there. There's some stocks that I believe are undervalued on a long-term basis. But the fact is, right now, I can confidently say more than half of the market is considerably overvalued, and much of the market is getting pretty close to overvalued, and there are very few stocks that, in my opinion, are at fair value right now or are undervalued. And when you get that type of situation, you're setting up for a stock market that is really, really dangerous if you're just flooding your money into an S&P 500 index fund, because I can promise you this type of valuation, this type of PE ratio on the market in general right now is not healthy. And if you're just sticking your money into something that mirrors the S&P 500, your money's just getting spread across a bunch of mostly overvalued companies right now, or companies that are very, very, like, knocking on the door, knocking on the door of getting to a place where they're overvalued. And why would you ever want to buy? I don't care what asset it is. I don't care if we're talking real estate, stocks, commodities. You don't ever want to buy into something when it's overvalued. You are just setting yourself up for a situation where you're going to get hurt, and you're going to get hurt for a long period of time, not a short amount of time. Like we looked at what the Dow did for several years. It did nothing, right? Most investors didn't make any money. We looked at the NASDAQ. The NASDAQ didn't go anywhere for 14 years. We're not talking about your money goes down for like 1 year and then it bounces back and you're like, we're all good now. It was only down for 6 months or 12 months or 18 months and we're all back now. No, when things get way out of whack and when they get overvalued, it can take 5, 10, maybe even 15 years for things to bounce back. So in my personal opinion, my warning is to all those folks that want to continue to flood in money to S&P 500 indexes when the valuations have been never a worse deal in recent times. Right now is not, in my opinion, the type of time where you should just, be like, I don't care about my money. I'm just putting it into an index fund. I do not believe that right now. I believe you need to be very, very strategic with where you put money and only put your money in the stocks that you believe the most in for the long term. And only put your money in the stocks that are actually still at a fair valuation or undervalued, which there's a very, very small amount of those stocks in the stock market right now. I look to, most of my day, every day is spent, Monday through Friday and even into the weekends is spent looking at companies, looking at company valuation. I can tell you there's a very small amount of companies right now that are undervalued. But the fact is there are still some of those opportunities, and for those opportunities you got to take advantage. But if you're spreading your money across, the whole market right now, just wait on it. Thank you for watching and have a great day.